Hello, Dev Nation. Welcome to episode number 7 of Money Talk Monday, where we try to break the stigma of money by talking about money. Today, we're going to be taking a look at dividend stocks 101, pretty much the basics of dividend stocks, the little terms and lingos that you need to know if you don't know about stocks. You're more focused on perhaps personal finance, you've never really looked into stocks, or really more specifically dividend stocks, but you want to better understand some of the terms and again some of the lingo in case someone brings up a conversation of actually investing in stocks. And again, we're also going to look at dividend stocks as well, so you can better understand some of the terms. If someone ever tries to talk to you about dividend stocks, you can at least pick up on some of the things that they're pretty much talking about. So we're going to go ahead and get into the basics first off. What is a stock? And so I'm going to go ahead and discuss the term, and then I'm going to go ahead and break down the definition, and from there try to give you guys a couple examples to better explain and understand the actual concept. So what is a stock? Well, the technical term is a security that represents the ownership of a fraction of a corporation. In other words, when you go ahead and buy a stock, you can buy a stock on a stock brokerage account with your stock brokerage account at the stock market. When you go ahead and you purchase a stock, you are now a part owner of that specific company. So for example, if someone says I want to go ahead and purchase stock in Amazon, once you purchase that one share of Amazon, that one stock, you normally say shares, you are now a part owner of Amazon. Although it's a very, 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 very small percentage of actual Amazon overall. If you look at pretty much the total numbers of shares that are out there in the market, there's like over millions of shares of Amazon. But still, because you own that one share, it is a very, very small percentage, but yet part owner of that company. So you are now a part owner of Amazon. So if you own 10 different stocks, again, that 10 different companies you are part owner of. So you can also think of this with Apple. If you go ahead and purchase one share of Apple stock or more, you are now technically a part owner of Apple. So that is pretty much the definition of a stock, the technical term, and looking at the example. Now, taking a look at, a dividend. So what is a dividend? Well, a technical term for a dividend is a sum of money paid to a shareholder. So again, that means you, the owner of that specific share, when you go ahead and purchase that one share or more of that stock, because you are now a part owner of that company. And so taking a look, think of it as the company sharing the profits with its owners, the shareholders. So you can honestly imagine, again, let's say back to Apple or Amazon. Think about when they go ahead and sell their products and they're able to cover all their debts and whatnot, and they made so much profit and so much money. They have all this extra excess cash that they don't even know what to do with it. Like they could go ahead and reinvest it back into the company, right? You could do that. But because they're just making so much money, they think, you know what? Even if we invest this money back into the company, we being the managers, the CEOs and whatnot, even if we go ahead and try and invest as much money as possible into this company, we don't think it's still going to help the company overall. So we're better off, because we have all this excess cash, just giving it to shareholders as a thank you for being a part owner of the company. So that's all a dividend is. It's like this extra little money as a thank you for being an owner of that specific company. And so now, how often is a dividend paid? Well, it does depend on the company. So the company actually decides this. Most U.S. dividend-paying stocks pay dividends every quarter, so 4 times per year. So that's going to be companies such as Apple, IBM, and Walmart. Now, you can also look at companies such as the REITs, Real Estate Investment Trust, O, Realty Income, is a ticker symbol O. They actually pay their dividends once every month, so 12 times per year. And by the way, a ticker symbol, for anyone who doesn't know, ticker symbol is pretty much just the name of the company on the actual stock market. So for example, if we all know the company Amazon, but when we go ahead and look them up online, we wouldn't type in Amazon, right? We would type in ideally Amazon.com, because that's the name of their website to get access to Amazon. It's the same thing. So with a ticker symbol, for example, Amazon, it would be AMZN. We would look that ticker symbol up, those 4 characters. Usually it's 3 to 4 characters, but who cares? Usually it's going to be AMZN. We go ahead and type that in when we're looking up a company in the stock exchange, and that pulls up Amazon for you. And it's going to be, again, of course, different for every company depending on what company you're looking for. Now, normally you can go ahead and just look up the name of the actual company. So if we're looking up Apple again, I actually tend to get that one confused. It's AAPL, but for the longest time I kept thinking APPL, because Apple, APPLE. You can just look up Apple and it'll go ahead and pull up AAP out for you on its own. But in case you didn't know, that's what the ticker symbol is. It's pretty much just another name to pull up the company that you're currently looking for. So yeah, so with realty income, they actually pay out 12 times per year. So again, it does depend really on the company itself. And normally they will tell you, when you go ahead and purchase stocks. And you can also look that information up on like Yahoo Finance and such, how consistent they are with their dividend. Now with the, we'll go ahead and break this down in the next one. So what is a dividend yield, right? So technical term, a dividend yield makes it easier to compare the dividends between different companies by dividing the annual dividend per share with the share price. So that's going to be, for example, if we go ahead and take a look, let's say Apple is priced at $10 per share. We go ahead and purchase a share for $10, and they're going to go ahead and pay out a dividend of $1 per year. Remember, it's up to the company specifically to figure out if they want to pay that dividend out four times within that year. So split that $1 into 4 different payments. Or for our other example, realty income, ticker symbol O, if they want to split that $1 into, let's say, 12 times per year, once per month sort of thing. Either way, the percentage or the dividend yield is the same regardless. So if we take that $1, divided by 12, that'd be less than 10 cents per month that you would get, but eventually it would total out to $1. Whereas with Apple, because they pay 4 times per year, you split that dollar up into 4 quarters, so you get a quarter every 3 months because they go ahead and pay out 4 times per year, but you still get the same amount of money regardless. So when it comes to dividend yield anyways, if they decide to pay it out 4 times per year or 12 times per year, what really matters is taking a look at, if you're worried about the price, take a look at the overall dividend that they're going to pay you over the entire year. Then from there, you go ahead and look at how they go ahead and pretty much split it up, again, depending on the company. I know with Disney, before they cut their dividend actually because of, the pandemic, I believe they paid 2 times per year, so every 6 months. So if, the dividend was just $1 per year, they will go ahead and split that into 2. So they go ahead and give you a payment of 50 cents 2 times per year if we're keeping true that, they have a dividend yield of 10%, let's say. All right, so that's pretty much dividend yield. Now, a common question that also gets asked, do all stocks actually pay dividends? And that is a no. Not all stocks pay dividends. Now, some stocks do pay dividends, but not all companies do. It is important to remember the company is not legally obligated to pay the dividends. So that's another thing. Again, with Disney, for example, when the pandemic hit, they realized, man, we really need to save up on our cash. We need to protect any cash flows coming in to go ahead and have that, extra cushion of protection, that margin of safety within the balance sheet. So they decided to go ahead and cut their dividend. That saves them a couple $1 billion, no big deal. And then from there, they were able to use those extra $1 billion to go ahead and make sure they could ride out the wave of this pandemic. And again, usually because if a company has to cut their dividend, it's normally because of some sort of freak accident like this, right? The pandemic, something crazy really has to happen. So I think another example could be the 2008 financial crisis, something that doesn't normally happen unexpectedly. This big thing happens and now they need this extra cash. But usually, especially when it's such a solid company like Disney, they're not going to cut their dividend, but it can happen. And really, that can happen to any company. So that is something to keep a lookout for. But again, not all companies do pay dividends. And if they do, they're not obligated to pay out that dividend. So that's something to really think about. Taking a look at next, we have what is a payout ratio. So payout ratio shows how much of the year's profit is paid out as a dividend. So generally, the payout ratio must be below 100%, right? Because you don't want to be paying all the profit that you're making as a company out in dividends. So preferably below 80 or even 60%. So yeah, usually 60% below is like that nice spot. Most companies I think are anywhere from 60 to 80, but it does depend on the industry. So this is also something to take a look at. It depends on, again, the industry that you're trying to invest in. So if you go ahead and try and invest, let's say Johnson & Johnson, they're going to have a different payout ratio than, some other company, let's say like Coca-Cola. So you want to usually compare Johnson & Johnson's payout ratio with some sort of other healthcare company as well. And same with Coca-Cola, maybe you would look at their payout ratio and compare that within their industry, let's say with PepsiCo, right? Usually those two companies are going to have a closer payout ratio. It just really depends on the industry. But now with a payout ratio, you don't want to see a company, again, going over 100% because that's 100% of the profits they're paying out. So if they're paying out 120% in the payout ratio, that means if I've made $100, I'm going to be paying out the rest of the owners $120, right? If it's 120% payout ratio, that wouldn't make sense. You would actually be losing money, right? So you usually want to see a company below 100%. Again, ideally lower than 80, although a good solid spot usually for most companies is 60%. That's a really nice cash flows. And so you can calculate the payout ratio by taking the dividend per share, the amount of money that they're going to pay out to you per share that you own, and divide that by the earnings per share. And that's pretty much how much money they make per share that you own. Quick little example as well. Apple earnings per share is $11.89. So if you take a look at the Apple payout ratio, their dividends $3.08. If you divide that by $11.89, you get 26%. So their payout ratio is 26%. Now, what is PE ratio? Well, PE ratio, or price to earnings ratio, is calculated as price per share divided by earnings per share. So you might also hear this as price per share divided by EPS, or earnings per share. It can be used to estimate if stocks are overvalued or undervalued. In general, the lower the PE ratio, usually the better. You can think of it as price per unit. So usually if you can find companies that are under a 15% PE ratio, that it does usually mean it can be undervalued. But again, it also depends on the industry as well. I know with airline industries, they are more likely to have a lower PE ratio. At least the last that I've seen, I believe it's like around 10 to 15%. Whereas a lot of tech companies, again, within the industry, like let's say, Facebook, Amazon, companies like that, they have much higher PE ratios, 30 to 40 PE ratio. And that's because they are higher value, because people see these companies as premium companies, if you will. So PE ratio, again, can just be used to estimate stocks are overvalued or really undervalued. And usually that sweet spot is anywhere from, it's usually about 15 to 20 for the PE ratio. Now, why would I waste $1,000 to get only $20 in dividends a year? I mean, I know I've had people ask this as well. Why would I spend even $10 to just get like a penny back or something, right? Well, this obviously comes down to your personal preference and also how you want to go ahead and invest your money. If you invested $1 in Coca-Cola in 1988, for example, the dividends in 2019 alone amounts to 0.990 cents. So that's 90% dividends for a single year. On top of that, you can add dividends for all the other years. All of this because Coca-Cola has grown their dividends each and every year for over 50 years. So that's why Coca-Cola is one of my favorite companies to just sort of even start off with, so you can better understand dividend stocks. Now, you can check out the graph pretty much. If you look at the graph, you see it's from 1995 all the way up until 2020, so the last 15 years. Pretty much it just shows a graph showing that they've continuously grown their dividend every single quarter, every single year. So it's very consistent. You usually want, when you're looking at your graphs on Yahoo Finance or wherever you want to get your financial information, you want to see that the company that you're going to invest in, if you're investing mainly for dividends, that they're consistently growing out their dividends. I know AT&T for a while was very consistent with the dividend. They would grow 1 cent per year to consistently grow it over time. And this tends to compound and compound. And now, why would you want to go ahead and invest, again, $1,000 to only get $20 in dividends a year, let's say? Well, this starts to compound over time. It starts to add up. So the first year, you have your $1,000 plus your extra 20. Then the second year, because you had that extra 20, you can buy a little extra and a little extra, and that starts to compound every single year. So let's say for every year that you get those $20, you decide to just reinvest. And after 10 years, you were able to get 10 extra shares within that company. And over time, it starts to add up. So now you're not only getting $20 per year, you're, let's say, making now $30 or $40 per year. And again, it just continues to grow and grow and grow. You can sort of think of this, a lot of people like to use the example of planting a tree. When you go ahead and you plant the seed into the ground, you water it, you're not really going to get much of anything from the plant. You're not going to get any sort of fruit or anything like that. But as you continue to water it, you continue to nurture it, then you might see a leaf. And it's still not much, right? You're not going to be able to get any sort of fruit from it or anything like that. But you continue to take care of it, you continue to grow it, and eventually you realize, wow, this avocado tree is producing, 50 avocados per year. And from there, you can plant more trees and more trees. It's sort of the same idea, but with money. So you can go ahead and, when you start off, it might not seem like a lot, but then it goes ahead and it grows into this thing that produces more for you, and you can use that additional avocados or with finance with dividends, that extra money to grow your little nest larger and larger until so you can pretty much just live off the avocados, or in this case live off the dividends, and now you're all set because you were able to be patient. It does take a bit of patience when trying to invest for dividend stocks specifically, or avocados. You got to be patient to go ahead and grow the 50 avocados, to see the tree really mature over time. It takes time, patience, and a little bit of technicalities and understanding, right? And then if you do want to actually go ahead and start today, because a lot of people then ask, well, okay, how do I go ahead and actually get started if I'm just interested in investing? Well, to start investing, you first need to go ahead and open up a brokerage account. Now, what is a brokerage account? Well, a brokerage account is an account that holds financial assets such as securities like stocks on behalf of an investor. So it's just an account where you go ahead and you open, just like pretty much any other account you would make for, I don't know, maybe some sort of website or a game. And you go ahead and you're able to trade stocks, and you're able to go ahead and pretty much purchase or sell shares of a company with that account. So, and a couple different ones that I've seen are Webull. You can check out Robinhood. Trading 212. Different companies like that. M1 Finance is another good one. So, those are a couple you can go ahead and check out if you want to go ahead and open up a brokerage account. But that's pretty much all my notes for how to go ahead and pretty much better understand dividend stocks and just like the basics of dividend stocks. But I hope you guys enjoyed today's dividend stock look. Trying to understand some of the terms and technicalities within dividend stocks if you've never really learned about dividend stocks, or maybe it's just a quick little refresher if you just haven't looked at dividend stocks in a minute. So I hope you guys enjoyed taking a look at just Dividend Stocks 101 and enjoyed today's Money Talk Monday, episode number 7. Wishing you guys all a great day, and thanks for tuning in.